Hello everyone, today we will explain to you about bookkeeping cycle. But before start, we would like to introduce myself. My name is Anastasia Paulina and I have 3 partners, Stephanie, Folipa, and Tata. Please enjoy your presentation. Let's continue the presentation on this first slide. What is bookkeeping cycle? The bookkeeping cycle is a series of outlined steps setting out the process required for a typical small business to record its financial transaction. In the bookkeeping cycle, there are several stages, namely transaction, journal, ledger, trial balance, income statement, closing balance sheet, opening balance sheet. The first steps in the bookkeeping cycle is transaction. The bookkeeping cycle starts with the day-to-day transaction arising from the trading activities of the business for the period. Example, Company A was incorporated on January 1st, 2010 with its initial capital of 5,000 shares of common stock having $20 per value. During the first month of its operation, the company engaged in the following transaction. Let's look at an example of a transaction. On January 2nd, transaction is an amount of $36,000 was paid as advance rent for the 3 months. On January 3rd, paid $60,000 cash on the purchase of equipment costing $80,000. The remaining amount was recognized as a 1-year note payable with an interest rate of 9%. On January 4th, purchase office supplies costing $70,600 on account.
To journal. After analyzing transaction, account, classify, and record the events having an economic effect via journal entries according to debit credit. Frequent journal entries are usually recorded in specialist journal. For example, sales journal and purchase journal. The rest are recorded in a general journal. Date 1 January transaction, cash common stock debit 100,000, credit 100,000. Date 2 January transaction, private rent cash debit 36,000, credit 36,000. Date 3 January transaction, equipment cash notes payable debit 80,000, credit 60,000, 20,000. Date 4 January transaction, office supply account payable debit 17,600, credit 17,600. Step in the bookkeeping cycle 3. Ledger. After posting all the journal entries, the balance of each account is calculated. The balance of an asset, expense, contra liability, and contra equity account is calculated by subtracting the sum of its credit sum from the sum of its debit set. The balance of liability, equity, and contra asset account is calculated the opposite YEA by subtracting the sum of its debit set from the sum of its credit side. Date 1 January transaction, cash debit 100,000, rolls 100,000. Date 2 January transactions, credit 3600. Date 3 January transaction, cash 60,000. Date 4 January transaction, cash 17,600. Date 2 January transaction, private rent debit 3600, rolls 3600. Date 3 January transaction, equipment debit 800,000, roll 8,000.
Okay, and the next slide is a trial balance. trial balance is a list of the balance of ledger accounts of a business at a specific point of time, usually at the end of a period such as month, quarter, or year. Therefore, the total of debit and credit balance of the trial balance are always equal. For the example, you can see the date on 1 January and the transactions is cash amounting to $100,000 in debit, and then 2 January is prepaid rent amounting to $36,000 and equipment $18,000, and on 4 January account payable in credit amounting to $17,000 and $600,000, and the total is always equal. And then the next step is income statement. Income statement is a financial statement that summarizes the result of a company's operation for a period. For the example, comparison in 2012 and 2013. The transaction is revenue, and then cost of sales. The result is gross profit, and then selling and distribution expense, general and administrative expense, other operating income and gains, other operating expense and loss. The result is operating profit or earnings before interest and taxes. And then the transaction is interest income, interest expense, net interest expense, and the result is profit from investment under equity method.
Hello, I'm Stephanie Srina. I would like to explain about closing balance sheet and opening balance sheet. Closing balance sheet is the closing entries or journal entries made at the end of an accounting period which transfer the balances of temporary accounts to permanent accounts. Closing entries are based on the account balances in adjusted trial balance. Example: Transaction 1. Account service revenue in debit, income summary in credit. Transaction 2. Income summary in debit, wax expense in credit, supplies expense in credit, rent expense in credit, miscellaneous expense in credit. Transaction 3. Income summary in debit, retained earnings in credit. Transaction 4. Retained earnings in debit, dividend in credit. Okay, the next slide. Opening balance sheet. The preparation of post-closing trial balance is the last step of the accounting cycle, and its purpose is to be sure that sum of debits equal the sum of credits before the start of new accounting period. It provides the opening balance of the ledger accounts of the new accounting period. Example: cash in debit, account receivable in debit, office supplies in debit, prepaid rent in debit, equipment in debit, accumulated depreciation in credit, accounts payable in credit, utilities payable in credit, net revenue in credit, interest payable in credit, notes payable in credit, common stock in credit, retained earnings in credit.
That brings us to the end. We hope this presentation has given you new insights on the bookkeeping cycle. Thank you so much for your time and attention.